Well, thanks for tuning in to Talking Point today. I'm your host, Niraj Shah. And this period currently is one that I haven't visited too many times in the past, wherein we've not yet finished an earnings season, and we are ready for the next earnings season starting this week as well. So earnings dominate, but as our guest on the show will tell you, he believes that Q4 gone by, or even the current quarter earnings that will get released in the month of July, practically hold no water. Maybe, just maybe, the commentary ahead would be important. And therefore, with Gautam Duggad, I will try and talk about what happened in the quarter four, what is likely to happen in quarter one, and all of that would be important. It'll also be important to assess his thoughts on the top ideas that Motilal Oswal is giving out to their clients, simply because I'm guessing, Gautam, that the ideation of what is to be bought and what is to be sold is not necessarily based on what will happen in quarter one, but maybe your assessment of what the commentaries could look like. Am I correct?
Absolutely, Neeraj, absolutely. Not just quarter one, actually, Neeraj, the entire FY21 seems to be a period of unusual disruption for the markets, right? We are sitting in July and we have obviously undergone 4 months of some variety of lockdown, which has impacted businesses ranging from consumption to investment to lending in a very different sort of magnitude. But what is clear is this is a one off kind of an year which you cannot use to base your investment decisions. Like you were pointing out, we've just finished 4Q and we are about to start 1Q from Thursday with, I think, one of the IT companies coming out with the first quarter results. What is important to look, Neeraj, in FY21, if I were to say this, is that look beyond the P&L, because P&L is going to get impacted for everybody in this year, in a very different sort of degrees. Maybe a consumer staple or a telecom company may have slightly lesser damage. Same for pharmaceuticals, but everyone will have some disruption in the P&L. The important thing to assess in FY21 with every passing quarter is how does the balance sheet and cash flow shape up? Because those who are able to manage their balance sheet and cash flow better, they will certainly emerge stronger in FY22 and beyond, and then can take care of P&L and growth. The other way to look at the same thing, Neeraj, is that if you were to look at FY21 EPS, obviously everything will look very expensive because the earnings have been damaged big
Yeah.
time in FY21, right? So if you were to go by conventional methods of price to earnings 1 year forward, you will find everything expensive. But what we have done is we've looked at the very basic intrinsic cash flows of Nifty. And we have made certain assumptions saying that FY21, let's assume it will be half of FY20 for non-financial Nifty universe. And then assume that FY22 earnings will look back to only FY19, right? This is just a hypothetical exercise that we've done. And then we arrived at the intrinsic value damage that should have happened because of 1 year of cash flow disruption in FY21. The number that we reach is somewhere around 14%, right? So if you wipe out this year as it is turning out to be, at least so far, then the damage to the intrinsic cash flows of Nifty should have been 13 to 14%. And that is what we have seen even in the markets. Obviously, you can ignore last 4 or 5 days of movement, but if you look at Nifty at 10,000, that was clearly reflecting the underlying intrinsic cash flow related impact on Nifty cash flows, right? So the way to see is just assess the management commentaries, how much normalcy has come back. I am told that various data points are now reflecting almost pre-COVID kind of numbers, whether it is electronic toll collection, e-way bills are inching up. We have seen PMI going up from 30 to 47. Obviously, rural has been relatively far lesser impacted. So that is in a very different territory altogether. And that is the commentary that came from our first digital conference that we did 10 days back, where 40 companies participated. And I'm not exaggerating, 40 out of 40 companies would have said that rural is in a far, far better shape than urban. And not just relatively, even in absolute shape. And
Hmm.
you are seeing how the monsoons have been. I think 32 out of 36 divisions have received rainfall already, which is either in line or slightly higher than the long period average. Kharif sowing has doubled YOY. So there are a lot of silver linings amidst the dark clouds. Just that we have to bear through this, disruptive FY21.
Yeah, that's a pertinent point. But I'm just trying to think out loud. that uh, when I looked at certain companies wherein their commentary and their performance as well during the April to June quarter, or their commentary about April to June quarter and the performance in the March quarter was not all that bad. It seemed that the markets rewarded them disproportionately. A lot of them in the mid-sized pocket. I mean, there's an APL Apollo, GMM Pfaudler, some specialty chemical companies which didn't see too much of disruption to their operations. Do you reckon that the markets would reward them disproportionately compared to the others, which might, even though they might see a normal FY22, might have a problem in FY21?
Neeraj, you made a very pertinent point that companies who could manage 4Q FY20 have obviously been rewarded well by the market. We have seen a knee-jerk reaction in March and April when we went down to 7,500, and now in line with the global markets, we have seen a reasonable bounce back of around 40% from the bottoms. What market has done, and I think this is not just a feature of last 2-3 months. Actually, if you scratch the surface, you will find that in the last 3 years, and you can take a reference point at December 2017, because that is when the mid cap index peaked. You will find that the market has anyways got polarized sharply, right? But within that, companies who were able to manage their numbers well have done reasonably well because you have a scarcity of growth. We just put out a strategy note 3 days back where we broke down the 15 years of the market performance and attributed it to earnings, dividend, and valuation related changes. The last
Hmm.
5 years is the only 5 year period in the last 15 years where we have actually seen a valuation derate. While we are all excited because it has moved up from 7,500 to 10,500, if you see it from FY15 to FY20, the market has done nothing. And absolutely, earnings have also done nothing, right? So, therefore, there has been a valuation derating. Clearly, companies in such period which are able to show growth, even 10%, 12% kind of a growth, because that is what we have gotten used to now. Gone are the days of 20, 25% earnings growth. Very few companies are delivering that. But if the companies are showing good balance sheet and cash flow stability, there is no leverage, there is no damage to the free cash flows, then obviously those companies are getting disproportionately rewarded. Obviously, last 6 months we have seen a very sharp comeback of healthcare. As of 30th June, if you look at the performance of the market, healthcare is the only sector which has given positive returns YTD. Consumer is zero. Tech, I think, has by and large been flattish. But virtually all other sectors have seen a double digit damage, while Nifty is now showing just 10% fall from pre COVID 11,500. So clearly, you have to keep an eye on both earnings as well as the quality of balance sheet and cash flow in such times, because you don't know who will have the capability to manage the fixed cost structure if there is a disproportionate period of disruption. Who
Yeah.
has got enough cash in the balance sheet? Those are the companies which I think will continue to trade at a premium for some period of time. And if you are able to get growth along with it, nothing like it. It's a cherry on the cake.
Yeah. Okay. So, your note speaks about a lot of such top large cap, mid cap ideas, and I'll get to that, Gautam. But before that, because I know that you yourself personally have a very good handle on consumption and consumption related names, amongst other things, while you head this research team at Motilal. What's your sense on the companies in the consumption stroke discretionary space that we know will most probably have a challenge, but the balance sheet may be okay? I mean, mall operators, hotels, so on and so forth. The businesses in all probability will not see a return to pre-COVID because there is a fear around mass gatherings. What do you, exhibition, theater companies, what do you do with such businesses wherein maybe the balance sheet is okay, but you don't know how the business will shape up?
Yeah. So, Neeraj, I will avoid those names, be it retail, hotels, or for that matter, aviation, because you don't know how the consumer will behave even when the even when the normalcy returns to the market, right? You don't know how many people will go and watch movies in theaters once the normalcy comes. So within consumption, the approach is very simple. I think consumption is a relatively simpler sector to handle. What you have to see is which are the companies which are gaining market share, which have leadership in their respective categories and have a good track record. Typically in markets, we sometimes underestimate the importance of past track record in the quest for looking at future. We always worry about the future, but sometimes we have to look back and see which are the companies which have handled the last 10, 15 years, or more relevant last 5 years in a very robust manner, because last 5 years you have seen a big growth slowdown. So I think one trend that will pan out in consumption, Neeraj, very clearly is the big will become bigger. Maybe this will pan out for all other sectors as well, because the smaller guys are finding a lot of problem in managing their balance sheet and working capital. And right now, the financial system, the banks or NBFCs are not very willing to lend to them. So clearly, there will be a market share shift which will continue from unorganized to organized. This is something which has been happening post GST, post demonetization also. So this trend will accentuate now. And I'm not saying just in consumer, even in consumer durables, cement, BFSI, many other sectors, this trend will pan out. In fact, in some sectors, you will find the smaller organized sector also losing share to the larger organized companies. So, in that context, therefore, what do we like? In consumption, our choice and pecking order has been extremely clear. For last 3 years, my pecking order has been Hindustan Lever first, followed by Britannia, Pidilite, and Titan. Titan obviously comes in discretionary segment, but clearly they've been gaining massive market share post the onset of demonetization. And virtually today, there is no national level branded jewelry competitor which is in existence. They're all regional guys. And I think this period will further strengthen the market positioning of Titan, and the opportunity size remains very large for them to benefit from. That aside, tactically, over the last 1 month, because of the preponderance of rural related upbit indicators that we have seen, we have also upgraded Dabur just a week back. Very strong franchise, very strong product portfolio, big CEO change which has happened there after 2 decades. Exciting strategy that they have. We had a chance to host them recently. So that is one name which we are excited about. And second, within the discretionary, which we call auto as a consumer discretionary, we've been very positive and M&M off late in the last 2 months. We think that they are at a confluence of positive factors. Tractor has been doing exceedingly well. In fact, in tractor, you're finding demand coming back and is turning YOY positive. They are actually facing a supply problem now. Secondly, the capital allocation narrative has
Good
changed for
problem to have.
M&M. Yeah, and secondly, capital allocation narrative has changed for a long after a long time. And again, there we have a big CEO change. And to add to all of that, the valuations are very reasonable for M&M on a core earnings basis. So those are the
Okay.
two stocks that we have added in the large cap space in our model, in our top idea list.
Interesting. Okay, so let me talk about those since you kind of mentioned them. Dabur, I thought was very interesting. By the way, the note that you guys came out, I think, unless I'm wrong, you also did a small interaction of sorts with
Yeah,
Mohit
we
Malhotra.
had an
A
interaction with.
very interesting thing. But my question is this: isn't it? Uh, is it so favorably placed, and are the valuations still giving you upside? Because yes, it's a leader in Ayurveda, and people are all talking about health and health related stuff. Plus, rural and Dabur is very well entrenched there. They know the game inside out. Do valuations allow for upsides in Dabur?
Let me answer that question in a slightly different way. See, in consumer sector, valuations, if looked at through the prism of 1 year forward P, has never given you comfort in the last 10 years to own any of the stock. Forget Dabur. I mean, if you had looked at Hindustan Lever in 2012, whatever the price at that point of time was, the P was 40 or 45. At 1,000 rupees, at 1,500 rupees, as 2,000 rupees, the stock always looked expensive. Same thing with Britannia. I have been hearing that stock is expensive since it was 275 rupees in 2013, and today it is, I think, somewhere around 3,500. So I think in consumer, one thing we have to learn over the last 10 or 15 years is that valuation does not necessarily mean 1 year forward P, right? Obviously, I'm not saying these are cheap stocks by any stretch of imagination. They are expensive stocks, and for a reason. What we have seen over the last 5 or 10 years is that the growth in the other sectors has completely collapsed. The investment cycle has been decimated in the last 8 years. We have seen what has happened with several other sectors where the growth is completely gone. And I think this whole lockdown and the pressure on the government balance sheets because of decline in revenue collection will ensure that the investment cycle gets pushed back by another 2 years. So therefore, in this context where the overall earnings itself is going to be very stingy, the sectors which are delivering even 8, 10, 12% earnings growth, be it consumer or a pharma or IT, will continue to have a preference. Now, within that, why I like Dabur is there are two reasons. If you see the track record of Dabur over last 20 years, and you can break it down into any 5 year period, you will find that it has been a very steady kind of a company. They have 10, 12 categories, out of which three or four they are number one, and rest of the categories they are either number two or number three. plus the track record of 15-16% earnings growth over a long period of time does showcase that they've been able to manage various cycles of raw material consumption slowdown. And in this 16-year period, you would have seen many years where there was a drought, and many years where you would have seen floods from a monsoon point of view. So that is one thing. And the most important point that has changed after COVID is that there is a tailwind which has come in now for health and hygiene related categories. And Dabur has several of those categories. You look at honey, Chawanprash, and so much other Ayurvedic stuff that they have in their portfolio. Plus, they have done rural distribution expansion, and they have a net cash balance sheet with very good ROEs. So those are some of the factors which drive our preference. Now, obviously, next 3 months, 6 months, nobody can predict. As you said, valuations in the near term, obviously, on a PE framework basis, does look expensive. So maybe there will be some time correction here or there. But timing has never been possible in consumer sector, even in the best of the times. So all you have to do is you have to look for good franchises with strong management teams and decent track record of delivering earnings growth in the past, and then hope that the market and timing will take care of the compounding will take care of your entry price.
In which case, there is an interesting addition that you made to the list, Tata Consumer. Not quite in the
Absolutely.
same league when it comes to consistent delivery year after year, and please correct me if I'm wrong here. But yeah, it's an exciting portfolio. But the problem, Gautam, again, is that it's back to the pre-COVID levels. So why Tata Consumer?
Neeraj, there is a very interesting case about Tata Consumer. If you see, Tata Consumer has been an underperformer for almost a decade, from 2007-8 till 2017-18. It's only after the arrival of Chandra at the Tata Group as a chairman that things started changing for Tata Consumer. Right? We initiated it a year back at 240 or 250, I think. Now, what is also happening in Tata Consumer, the two things which are changing is the focus on branded India business and the focus on return generation on capital efficiency. Whether you look at it through the prism of ROIC or ROE, what has impacted Tata Global, as it was used to be called earlier, for almost a decade and a half, their focus was on overseas business. That impacted their cash flow generation, their ROEs, and earnings growth predictability. Incrementally, that is changing. The focus is returning back to the India business. Second thing, they have absorbed the foods business of Tata Consumer, which obviously provides them a massive opportunity because the size of the categories in which they will be present, whether the condiments, spices, staples, is huge in India, and most of it is unorganized, unbranded. So there is a large canvas to play for them. And third is we have seen some delivery already on numbers front. If you look at their operational cash flow for FY20, that has gone up significantly. And I think in the next 2 years, they will have a free cash flow generation of 700 to 800 crores. And last point that I wanted to make on Tata Consumer is there also we have seen a CEO change. Now, Neeraj, specific to consumer sector, if you look at the last 20-25 years of track record of different consumer companies, whenever there has been a big CEO change after a long period of time, it has created multiple years of outperformance, not just 1 year, 20%, 30% upside. You start with 1998 with Dabur, then you move to Marico and GCPL in early 2003, 2004. Then you move to Nitin Pranjape in Liver in 2008, Varun Berry in Britannia in 2012. Then we had seen Suresh Narayanan coming in Nestle at 2000 in 2015 after the Maggie crisis, and what he has done over the last 5 years. I'm not saying this pattern will repeat, but
Yeah.
I think when a new CEO joins with a tremendous track record and the company has decent brand franchise and distribution scale, I think a lot of possibilities open up, and that is what is driving our faith in this story. So far, it has done well, but I think there is still a long way to go. It is just a 3.3 billion dollar market cap company. In the next 3-4 years, the possibility of this company becoming pretty big is very strong because the opportunity that they're staring at in the foods business is excellent, and any incremental ROE improvement, market will obviously disproportionately reward that.
Gautam, can I ask you? I don't know if it's a part of your published note and therefore whether you can speak about it or not, but if you can, that is, and completely fine if you cannot. But if I were to ask you your gut feel for a business that will become much larger than what it is right now, over a 5 year or a 7 year or a 10 year period. I mean, if it is possible to say, and again, I repeat, completely fine if you cannot.
Sure. I think I'm just thinking it loud. And clearly, those businesses need not necessarily come from a mid cap space. It can come from
Yeah,
large cap space. For example, one of the companies where I think over the next 1 decade, which can surprise you big time, and again, it's not an undiscovered story. It's part of the India's top 10 market cap companies. Is Kotak Bank itself. You know, I think the delivery that they have done over the last 1 2 decades has been phenomenal, and financial savings space is just getting unscratched. Plus you have a big opportunity still because 67 to 68% of the market share is still controlled by PSU banks. Quality of their underwriting has been extremely strong. If you get a good compounding for next 10 years again, this itself can create a huge wealth. Then there are multiple consumer opportunities which I just spoke about, the likes of Titan, the likes of Pidilite, the Britannias, Daburs, Levers, Tata Global, you yourself mentioned. These are many companies which can become very big. Then in the
okay.
discretionary space, which is where I think the real delta will happen, because whenever the incremental consumer disposable income goes up, large part of it will now go toward discretionary products because the basic needs are taken care of. So in that categories, you have a lot of companies which are delivering good performance over the last 3 4 years, whether it is a consumer durable space where you have the likes of Havells, Crompton Consumer, or Whirlpool, or for that matter even in the specialty retail space, names like Bata, Relaxo, which have already done well. I think a lot of times the mistake that we make is we always try to hunt for something which is very new, which is very small, and therefore the amount of risk that is taken is disproportionate. I'm not saying that's a wrong style. Every style works in market. What matters is what works for you. Personally, I feel companies which have already proven themselves and where the size of the canvas is large, and we think that they have the drivers in their P&L and balance sheet to compound, those are the names where I think the risk will be slightly lower. Maybe return will also be slightly lower, but at least you have certain track record to go with.
Yeah, because remember there are thousand ways to skin a cat. You can
Yeah,
choose which one is the best one
yeah,
that works for you.
yeah.
Gautam, one final question really on this conversation, and thanks for sharing a lot of these ideas because it's food for thought for everybody who's watching this as well.
Sure, sure.
We've spoken about consumption and banking, all of which make people gravitate towards themselves, and therefore the businesses can grow. One of the interesting bits in your report was also the city gas distributors. I think there is one name that you've included there, but I think the space at large is finding a lot of favor from your peers as well. My question is, it's a regulated business. Uh, is it the so therefore the chances of price hikes etc. is not there? What is the thesis? Is the thesis that a lot of people will start using it, and can it actually be uh, a business that is multiple times larger in the next few years, or is it a steady 10-15 kind of percentage business growth that you will see there?
So, Neeraj, all the three companies in that CGD space, either IGL, MGL, or Gujarat Gas, have a very good track record over the last 3 5 years. Whether it is EBITDA on a MMSCM basis per this thing, or the ROEs that they have generated, or in fact, in the last 3 years specifically, the earnings growth also. As you rightly pointed out, the risk always is regulatory in such kind of businesses, which prevented us for a long period of time to turn constructive, right? After a long time, when we deliberated with couple of regulators and channel partners, we realized that even if those regulations were to come, they will take their own sweet time. And the one of the important thing in this space is they are all on the right side of the evolving mega trend, which is that there is a preference for cleaner gas consumption. NGT has been very severe on many of the industries which have been using dirty fuels. Plus, in general, you are seeing penetration of CNG going up. And there is a general, I mean, I know it's not very specific to any particular companies, but for the space, it has been very positive that the mega trend which is evolving is the preference towards relatively more cleaner fuel consumption. And in that context, all these three companies have different advantages. Gujarat Gas is slightly more tilted towards the industrial side of the equation, whereas IGL and MGL are more towards CNG and household consumption. We think that over the next 3 to 5 years, these players can compound at 15 16% from earnings growth perspective. But more importantly, their capital efficiency ratios remains very strong, which is upwards of 20%. The only risk which we will have to navigate along the way is if there is any adverse regulatory judgment which comes in. That is when we will see. But relatively, our preference at the moment is Gujarat Gas because of the discount that it currently has in valuation compared to someone like an IGL.
Okay, Gautam, I would love to talk on for the next 20 minutes because this is turning out to be a fabulous conversation, but I understand there are time constraints as well. So good having you, Gautam. Thank you so much.
Pleasure.
Gautam, it will be lovely to talk to you post the quarter 1 numbers are out, just to make sense of which commentaries impressed you guys at Motilal Oswal the most. So let's
Sure.
try and do that conversation 1 month out.
Definitely, Neeraj. Thank you.
Great. Thanks for joining in today, Gautam. And viewers, thanks for tuning into this edition of the Talking Point.